Peter Ricchiuti. He is the finance professor you wish you had in college.
Well, I know he's definitely the finance professor I wish that I had had. Peter Ricchiuti is the assistant dean at Tulane University's A.B. Freeman School of Business, and his insight and humor have twice made him the school's top professor.
Après une brillante carrière à Wall Street, Peter a travaillé en tant qu'assistant trésorier et chef des placements pour l'État de la Louisiane.
Now that bears repeating. After a successful career on Wall Street, Peter worked as the assistant state treasurer and chief investment officer for the state of Louisiana, where he skillfully managed the state's $3 billion investment portfolio and served on boards overseeing another $8 billion in retirement funds.
He and his program have been featured in the Wall Street Journal, the New York Times, CNN, and CNBC.
In 1993, he founded the Burken Road Reports Investment Research Program, a program where he leads 130 investment students in search of the skinny on undervalued stocks in 4 southern states.
We're very pleased to introduce Mr. Peter Ricchiuti.
Thank you. This is terrific to be here. Beautiful place. Met some wonderful people already. And you know what's really great for me, though, is I teach college kids for a living, so it's just terrific to see adults. It really is. You look super. You really do. And I can relate to you better than I can my college students because we're about the same age. You know, we're at that stage of life where the term pulling an all-nighter pretty much means sleeping through the evening without having to get up to pee, you know. So you're my people. This will work out. I've always enjoyed working with Canadians. I've given talks all through the country, and though here I've met some very smart, I assume very smart Canadians because they have those really big heads. I don't know, the very curious group. Let's see what we have here today. All righty, market signals. This is the way we feel on campus every spring. In 6 more weeks, these MBAs will be ready for market. Which is sort of true. We have really enjoyed, one deal you'll probably get from the cadence of my speech is I live in Louisiana, New Orleans, Louisiana, which is the southern part of the United States, and I don't speak like I'm from there. I'm originally from Boston. I speak far too quickly to be from Louisiana. In Louisiana, this would be maybe a month's worth of material. But I married a local girl. I'm raising 2 Cajun kids. Got the whole thing going, and it's funny because when I got my job managing all the money for the state of Louisiana, a lot of people still having that war in the United States in the North and the South, and I realized that because 2 weeks into the job, I had to testify in front of a Senate committee, and I got up there, and the senator said, "Before you get underway, why don't you tell this committee where you're from?" And I thought, oh, God. So I thought quickly. I said, "I'm from the state treasurer's office, sir," which I thought was a good answer. And then he said, "Where was you from before that?" And I said, "I taught finance at Tulane University in New Orleans, sir." And he says, "I think this committee about had it with your foolishness. Where was you born?" And I told him Boston, Massachusetts. He said, "Fine, I just think the committee needs to know what we've been dealing with here." So so I've gone through a lot. I'm really ready for anything. Couple of things. Don't take any of this too seriously. One reason you might not want to take any of this too seriously is my own short-term investment track record. I have been actually a very good long-term investor over the years. I've been doing this for 26 years, but short-term I've had my problems. I'll show you on this here. There we go. If you see the Wall Street Journal has a contest once a month on the front of the C section, and it's a rough contest. They pick 4 money managers, and they ask them to pick one stock that'll do well over the next 6 months. Now, this goes against everything we teach at the university because we're trying to create long-term minded investors. And, of course, one stock doesn't make a diversified portfolio. And then just to intimidate the heck out of you, they take the Wall Street Journal, put it on a dartboard, and wing 4 darts against it. And that's me on the far right-hand corner there. That is actually before I started the Atkins diet. And actually, I think it's that pointillism design adds about 30 pounds to you because like Judith to my left, she looks terrific. I assume she was actually anorexic. She looks fine. But and I recommended a company called Draco Energy Services, and this is why I'm so committed to long-term investing. I don't know how many of you have ever drilled for oil. I know Canada is a great oil-producing region, but if you've never drilled for oil, I think Susan's taking you for a tour at the break here. But if you're drilling for oil, one of the keys, of course, is to drill down. I think that's where so many of you are having your problems. Now the Calgary people, they're okay and everything, but but if what this product was, Draco made a product called the Mud Motor, and that's the stock I recommended in the Wall Street Journal. The Mud Motor allowed you to go back into the well bore of a well you'd already drilled, go down, turn the drill bit, and go over and pick up the oil you may have missed the first time around, as you can see over to the right-hand side. And I thought, this is going to be a very popular product because, this isn't even your land, So they're not going to keep this baby on the shelves. And this is what happened to me in the contest. The stock price is on the far right. It's $25, $30, $35 a share. The contest basically started at the far left, and about, I'd say on this screen, about 1 foot before the end of the contest, that's where the contest ended, just before it took off. So I recommended the stock at 26. It closed at 26. I lost to the darts. I came in 4th out of 4, and 7 days later, the stock was at 43, and 2 months later, it was bought out at $74 a share. And but I learned so much about myself, though, because I told my wife what happened. I said, honey, what stock I recommended in the paper? Well, now the game's over and the stock's soaring. And she said, well, don't we own some of that? And I said, yeah, but I lost the game. And that's a sign you need to get out more, really. I have had better luck in the past, so you have more confidence in me. I was in a stock picking contest against one of the top finance minds in America. Mike Ditka, the former coach of the Bears, was able to beat that. And the strangest thing I've ever done, that's why and I've been in your business, I know how difficult it is to get people to understand financial concepts. Because I was the investment instructor for the New Orleans Saints football players for a number of years. And these were just unbelievable. They were just gigantic men with huge amounts of money and that had no idea what to do with it. And so we worked with them. We created a pension plan with them, and it was a lot of fun. And I always remember, because I have 2 wonderful boys. My oldest is named Matthew, and he's 10 now. But when he was 5, he was. I had him at home, and I brought home the Saints roster, and it had the roster of what their position is, where they went to college, and their height and weight. And I went into the kitchen, and my son's working on the roster, and he's scribbling out some stuff. And then he says, Dad. And I said, what? He says, this guy. I said, what about this guy? He says, Dad, this guy weighs more than our family. And I thought, God, it was just so touching as a math professor. But there we go. Now, here's the things you got to remember. One of the great things about working with you, I love seeing it in French over there. That is great. I took 3 years of French 1, so this really worked out great. All I remember is "Oui, je suis Monsieur Thibault," and I went around France. I remember for 2 years looking for my hat. It was very incredible. But since World War II, the great thing about you working with a group like you is you've seen market cycles. You've seen the economy go up and down. You've seen the stock markets go up and down. When you teach in a university, you don't see that. Tulane is a top business school. The average, for instance, last year we had 17,000 applicants for 1,500 freshman slots. The average GMAT is a 680. I'm now the assistant dean of a school I could no longer get into, which is sort of interesting. But But they've never seen any cycles. If the economy's down, they think it'll always be down. If the stock market's up, they think it'll always be up. But you know better than that. And see, since World War II, we've had 9 recessions in North America, 21 market declines of 10% or greater, 8 market declines of 20% or greater. And what counts is corporate earnings. So we've seen these cycles before. Since World War II, corporate profits are up 63-fold, and stock prices have risen 71-fold. And the important part there is those numbers are very close together, and they're telling you that ultimately that is what moves stock prices, is earnings, company earnings. And that's very, very important. We get a lot of noise. One of the problems we have trouble in developing clients to get long-term financial game plans is they get so much noise at them. They have all these news broadcasts and newspapers and radio and such, and they get too jittery. They get too jittery to stick with a long-term plan. That's where you come in. Because one of the things that's really true, think about this line. If a majority of the people were right, a majority of the people would be rich, and they're not. And that's just the way it is. It's the idea that you are saving a lot of clients from themselves. Ideally, or not ideally, but usually you will get a situation where clients are kind of hardwired to blow themselves up. They want to do the wrong thing at the wrong time, and you're there to kind of keep them on track. Now, I think that nervousness about the market might be uniquely in North America. I don't know, because I was giving a speech for the Bank of Ireland last summer in Dublin, and I watched the Bloomberg television, their financial news, only it was from the UK, and they seem a lot calmer over there. I turned on the TV, and there was a blonde anchor woman, and she says, "Now this stock has fallen over 60% today, and that's not good, is it?" And I thought, wow, man, that's great. That's the way we ought to do it, you know? God, I worry about things that don't even bother other people. Let me just say, am I the only person here that's troubled by the fact that the board game Monopoly is made by only one company? See, these are the kind of things that disturb me. Let's see. Couple of things. Hang in there in terms of the financial markets. If you take a long-term game plan, over the past 30 years, the stock market has produced an average annual rates of return of just under 11% annually. If you were out of the market during the best 30 months of those 30 years, your rate of return would have dropped from 11% to 3%. And that's a very good argument for sticking with the game plan for the long term. Now, in the late 1990s, everybody really thought they were going to get 20, 25, 30% on their money in the dot-com situation. And that wasn't repeatable. We knew it didn't make any sense. So you could go to any actuary, and they would show you that these are the long-term numbers. But I don't know if you've ever hung out with actuaries, but they're kind of a creepy group, really. I don't know. They just kind of, an actuary is the kind of guy who goes into a restaurant, sees a beautiful woman, and thinks, hey, she'll be dead in 34 and a half years. It's just not our kind of people, really. But God love them, really. There's, now, one of the important things that shows up in every academic study is what really drives long-term performance. And when you look at what your money does in the long term, the key drivers to long-term performance are asset allocation. In other words, the big picture decisions that investors make. How much was in stocks versus bonds? How much of it in stocks was international versus domestic? How much of it was small cap versus large cap? Those big picture decisions are driving 90 to 95% of your long-term performance. And interestingly, the reason I put it in a pie graph is that we tend to spend an opposite amount of time, inverse amount of time in terms of what we focus on. We tend to focus on which stock, which fund, which money manager, and that's not where the driver is. I don't know why. I assume Bob Parent put this in. I don't know where this slide is. I say it was done by a couple of college professors. They're working on very important things. This was a study, probably took years to show, that no matter what country in the world you're in, stocks do better in cold weather. I have no idea what to do with that. God love them, my brethren. Let's see. Now, that's what we're going to talk about today. We're going to talk about energy issues, deficits, interest rates, domestic politics, valuation levels, inflation, international investing demographics, and labor. It sounds like a lot, but these are the topics we're going to try to hit on this morning. Couple things. Deficits. The deficits count. The deficits definitely count. Now, President Bush it says the deficits don't matter. I don't know. We go over this just before the midterm. I don't know where he was. This is a big deal. This is not a gray area. This administration suffers from what I call a deficit attention disorder, which is actually kind of a new disease, really. But I don't get it, really. But and we got the trade deficit. That's a big deal, the weak dollar. One of the things that surprises a lot of non-financial people is they're saying, well, in the U.S., Alan Greenspan, the head of the Fed, keeps raising interest rates. Doesn't he know the economy is really still pretty weak? But he's really in a trick bag or in kind of a rock and a hard place because his situation is the dollar has been so weak that he needs to raise interest rates to attract foreign capital into the country. So he's really kind of trapped there in a little bit, and that's one of the things we're going to have to deal with. I do think the weak dollar is going to create some very interesting stories down the road. I don't know if you saw about 5 weeks ago, but Chevron Texaco was bought out Unocal. Well, the other two bidders for Unocal were the national oil company of China and an oil company from Italy. And that is what you're going to see. The weak dollar has created situations where you're going to see a lot more foreign ownership of North American companies. And I think that's going to be a big story going forward. Let's see. Energy issues. And I actually know quite a bit about the energy issue situation in Canada. I've followed a lot of those stocks up there. But here's the bottom line. Oil and gas prices will remain stubbornly high. You're seeing a lot of analysts coming out and saying, oh, this is $50 is a blip. It'll go right back to the high 20s or the low 30s. It's not. That's a pipe dream. There's no way that's going to occur. This is the reason. There is strong demand, particularly from China and India, and that is not going away. It is not. You're not going to get the genie back in the bottle. You're not going to get all of a sudden a bunch of Chinese guys that say, oh, I really miss my bike. That's just not going to happen. It's not going to work that way. And they've seen the car and they're excited about it, and and the other thing is the supply side is very, very weak, and I know this because we talk to oil companies all the time. There's increasing reserve decline rates. This is not only in the U.S. but also in Canada. Whereas 15 years ago, you would hit a reservoir, and maybe it would produce for 10 or 15 years. Now, when they hit a reservoir, on average, it's producing 3 to 4 years. So the reservoirs are smaller, they're being sucked out quicker, and there's a shortage of new prospects. The oil and gas companies are filthy rich at this point, but they don't have a lot of new places to drill. And, I'm going to show you a little bit about my program at Tulane, where I have 200 students, and we go out and we visit small companies in 6 southern states. And the interesting thing about visiting small companies versus big blue chip companies is they don't have spin doctors. They just kind of tell you the way it is. And I remember this because in December we were visiting an oil company in Lafayette, Louisiana, and one of my students asked the chairman, she said, "Sir, if oil prices can stay at $50, how do you think next year will look for you?" And he says, "Young lady, we keep oil at $50. Next year, we'll be farting through silk." This is way too candid. Let's see. Here's the important part. Interest rates really tell you where the economy is going. And it's been right since the earth cooled. But nobody wants to pay any attention to it. Instead, we do crazy things for the economic data. We usually send a reporter to a Walmart in Tucson and ask the first couple of people coming out with overalls, "You think the economy's bad? You think you're going to lose your job?" It's like, "That's right, I'm scared, real scared." And it's like, "Back to you, Bob. People are scared." That's the way we're doing our surveys. This is ludicrous. The interest rate curve tells you where the economy is going. Take a look at September of 2000. The economy had been rocking and rolling for 8 straight years. We had 8 years of peace and prosperity. I had people telling me, "Peter, your whole talk is about business cycles." I'm thinking like maybe there are no more business cycles. Like maybe it's always going to be good. Maybe it's like a new paradigm. No, it's the same paradigm. So you take a look at what the yield curve was telling us there. The 3-month Treasury was at 6%. The 10-year was at 5.70. This is what we call in the business an inverted yield curve. You were getting a higher rate of return on shorter-term paper than you were on longer-term paper. When you see this, it always means the economy is about to slow down and corporate profits are about to sag. It is always true. And, of course, that's exactly what we saw, a sharp decline in corporate earnings, right, 6 to 9 months later. In July of 2003, the economy had been down for a number of years. The stock market had been down for more than 2 years. People were saying, "Oh, we'll never pull out of this. We'll be like Japan. We'll be selling pencils in front of the stock exchange." That's not what happened. Look at the curve there. The 3-month was at 0.95. The 10-year was at 4.35. The difference was a positive 340 basis points. That means that was the biggest slope since the Great Depression, and it was telling us that we were going to come out of this in a big way, and we did. And then 6 months later, we had 8 quarters in a row of 20% corporate growth or better. So that was right then. Now it's interesting what it's telling us, because it's telling us that the 3-month is at 275, the 10 years at 4.25, the slope is at a 150. So what it's telling us is we are going to see a slowdown in corporate profits in the next 6 to 9 months. Maybe not off a cliff or anything, but the market is telling you there will be a slowdown in corporate profits. And it'd be interesting to see how this transpires. Domestic politics, this is just for the U.S. market, but I think it's kind of interesting. The first year of a presidential term is usually the worst for stocks, and that's really been true since the turn of the century, which, well, it's okay when I do that with you. You know what happens when I do it to my college students and I say turn of the century? They go, like 5 years ago? It's like, no, it's more data than that, Bobby. There's, God, and I worry about this generation. Like, I had a student that came to see me about 3 weeks ago, just before graduation. He'd come by, and he was an underclassman. And he came by, and I talked to him about his career for about 20 minutes. And as he was leaving, I said, "Robert, I'm sorry, what year are you in?" And he said, 2005. He's like, oh, God help us. Now, one reason you might see this is that if you're a cynic, you'd say the party in power tries to juice up the economy to get reelected, and then it kind of falls apart. But even if you're not a cynic, the first year is usually worst. The third year of a term is best. The fourth year is second best, and the second year is the third best. That's the way it kind of works over time. This, I think, is very, very interesting. I think this is the best model there is to look at the stock market, whether it's in the U.S. or Canada or wherever it's going to be. This is the best model there is. Let me just ask you, how many people here have a tattoo? A couple of people said they wanted to come up. Was it you, ma'am? And show, was it? No, sorry. Oh, yeah. Everybody has a lot of courage at breakfast, and it's like, oh, no. Now, if you're thinking of getting a tattoo, because you come to these places and really things get out of hand, I know it. They really do. Before you know it, you're in a bad part of Tucson. If you're thinking of getting a tattoo, this would make an excellent tattoo. It's earnings per share for the S&P 500 divided by price of the S&P 500. equals the yield on the 10-year Treasury note. Now, it takes a big body part, but I believe it is tax deductible. So it's this is telling you, if the market is perfectly priced, you will see that equation, EPS for the S&P 500 divided by price for the S&P 500, should equal the yield in the 10-year Treasury. If we look at it right now, we see that the trailing earnings for the S&P 500 are 65, the S&P is at 1160, that comes to 560. Right now, we know that the 10-year Treasury is yielding about 4.10%. If this market were at parity, it would be yielding at 5.60%. What this is telling you is that this is actually a pretty cheap stock market. Now, I'm not saying the market's going to fly up tomorrow or next week or a month from now, but in terms of an entry point, it's really a pretty good, pretty reasonably valued stock market. Now, this graph here shows you exactly what would happen if you had used that model. It would have saved you from a lot of misery. This goes back almost my entire career, 26 years in the market. And if you look at this, basically what it's saying is that if the market is perfectly priced using the model, you'll see it kind of hit around that hash line going across the middle. If it's overvalued, it'll be above the line. If it's undervalued, it'll be below the line. Look at where we were in the spring of 2000. Now, it may be the angle I'm at, but it looks like we may have been a tad overpriced. That's what I'm thinking. I mean, it was so obvious, and yet you couldn't tell people that, you know. I'd show this to people, and they go, like, maybe it's broken. It's like, no, not broken. And I remember this because in the spring of 2000, I was giving a speech in South Carolina, and I was in the green room ready to go on, and a money manager came up to me, and he said, tapped me on the shoulder. He said, Peter, I know how you feel about the market's valuation, but we got a business to run here, and if you could just say something positive. And I remember looking at him and saying, would you accept 2 negatives? And and of course the market collapsed. Now we're looking at a market that's as cheap as it's been really since this bull market started in '82. So it's really, in terms of an entry point, really pretty attractively valued. Now, the market is a forward-looking indicator, so if you look at what's going to happen for the next 12 months, they think earnings will go to $71 for the S&P 500, divided by 1160 equals 612. This is telling you that the market is betting there is a significant increase in interest rates coming down the road. In fact, if you look at this, it's about 200 basis points. They think rates will go from roughly 4.12 to about 6.12. That's what the market's betting on at this point. I don't know if that's going to happen, but if you want to know where people are putting their money, it's in that equation. Where's the thing I was going to show you? Oh, I saw a couple of people reading this. I don't know if you saw that. You get the Arizona Star, the paper today, which I really loved. I saw the greatest story in here. What was it? I wanted to share it with you. Oh, here. They have a part. They have a part where they do, I guess, little news items, you know, that I guess really aren't big items, but it was in the metro section. And this was great. This was in Mesa, Arizona, and I said, I'm going to share this with them this morning. Mesa's, I guess, north of here. It's kind of outside of Phoenix. And this is a great story. In Mesa, Arizona, last night, thieves broke into a pharmaceutical warehouse and stole 2 pallets of Viagra. Now that is a great story. That is a great story. It says here that the Mesa police are out looking for hardened criminals, which I thought was kind of an interesting angle on it. I think there's what a state, what a state. Let's show you why. I think, there's a lot of people are saying, I'm afraid of the financial markets because I'm afraid of inflation really souping up, or I'm afraid of deflation really cranking itself up. I'm going to tell you that I don't think we have to worry about either one in a big way. And the reason is we have 2 offsetting economies going on in North America. We have an inflationary side and a deflationary side. Those industries that are making significant gains in productivity are the ones seeing deflationary pressures. Consumers here are literally getting more for less. The examples would be Dell, Toyota, Walmart. This is where you're seeing prices drop. The best example I found is that in 1979, it took GM 41 hours to make a car. Today, it takes them just 24 hours. That is huge. And that is the deflationary side. Now, I live on the inflationary side. I'm a college professor. I can't grade papers any faster than I'm going. It's like, woo, woo, woo. You gotta read them, So those industries that are labor intensive have made very little progress in productivity, and prices for these keep rising. Consumers here are literally getting the same for more. The examples would be college tuition, sports payrolls, Boudreaux's Auto Repair. These are all places that are labor intensive, and the prices keep rising. The best example I saw is that in 1788, it took 5 musicians to play a piece by Mozart, 2 violinists, 2 violists, and a cellist, and it still does. So so some stuff is not going to get outsourced. It really is really not. Because I worry about outsourcing. That's a big problem in the U.S., a big problem in Canada as well. I'm wondering if they're going to outsource public speakers. They could do it. Next year they might say, oh, I can't afford Peter. And they bring in like a professor they fly in from India or something like that. That could happen, It's next year a guy gets up here and says, oh, very funny story. There are 2 brokers from Bombay. And they you never tell. It's a funny business. Let's see. I do think that one of the problems, and this is less so in Canada than it is in the U.S., is a very myopic kind of thinking when it comes to investing. 2/3 of the world's securities are outside of the United States. And it's very, very important because there's a lot of opportunity out there. I see, for instance, at Tulane, we have a top MBA program. And one of the things that I see is a funny little angle on it is that when I started in 1986, the foreign students they had a lot of trouble getting jobs because of visa restrictions. Now I see that much, much less so. In some places they have an advantage because U.S. companies are saying, U.S. is going to be fine, North America is going to be fine, it's going to grow at 4, 5, 6% a year, but the big growth is in these emerging nations like China and India, and the model they're using is they're having these creme de la creme students come from those countries, come to the top MBA programs, and then they hire them, have them stay in the U.S. a couple of years, and then go back and run their operations in their home country. And that tells me there's a lot of growth out there. And my foreign students, of course, do better. They're always at the top of the class. You know that. Kind of predictable. My foreign students are going home at night and doing calculus equations in their apartments. My U.S. kids are in the French Quarter doing Jello shots. So it's kind of a predictable run in here. Pig in the Python. Investing demographics, I think, mean a whole lot. And that is, if you look at the birth rates in North America, they're pretty steady all the way through until you get to that period from 1946 to 1964, we call the baby boom years. And then it's gigantic. And I use Pig in the Python. If the picture is a snake, there'd be one big bump where the pig was. And so if you look at that, that has always created huge opportunities. Where the baby boomers were, what they needed, created huge opportunities. And frankly, the best opportunities out there are in your business. They are in your business because these people are getting very serious about their money. They're a huge part of the population. And financial services is going to be, I think, the #1 industry going out for the next 20 years. Healthcare, I think, is going to be big. Leisure, whether it's cruise lines or RVs or whatever, I think that's going to be another important area, though. Let's see. One reason I'm optimistic about the labor market is that right now it is very cheap to bring on a new unit of labor, and I think that's why you're starting to see better labor numbers come through. Here's an equation the U.S. government puts together. Unit labor costs divided by after-tax unit profits. What it's measuring is how much does each new employee bring to the bottom line after you've paid their salary. And one of the interesting things that comes of it is this graph here, and it shows that it is now cheaper to bring on a new unit of labor than it has been at any time since the late 60s. So that is what's going to drive the labor market going forward here. There's not much question in my mind. Here's something that's sort of interesting. People have forgotten completely why a stock goes up and why a stock goes down. I ask people all the time. I say, why are you buying that stock? They say, you know why? Because my uncle worked there 19 years. Oh, terrific. That's great. Or they make the best Pop-Tarts. Oh, it's super. That'll help us. It's price divided by earnings per share equals PE ratio. So if you're playing along at home, we're trying to get the numerator up. And so if you look at this, PE is a measure of sex appeal. The higher the PE is, the sexier that stock is in the eyes of investors. Another way to think about it is the higher the PE is, the more optimism is already pumped into the price of those shares. I'm going to show you the little companies that we follow with our students at Tulane. Nobody's ever heard of these companies. We call them stocks under rocks. No, they've so little optimism in them. If just people show up for work, the stocks go up. It's incredible. But but take a look at Home Depot, for instance. Stocks at 43. The earnings are $2.26 a share. The PE is 19. If you're buying shares in Home Depot, any stock, there's only 2 reasons to buy the shares. Is either you think the earnings are going to go up, because if the earnings go up, that'll drive the price up, or you think the PE is going to go up. It's going to be viewed as sexier in the eyes of investors. It's going to have maybe geographic expansion or margin expansion or something like that. Well, that'll drive the price up, or some combination of the two. But that's really all there is. Just skip through this one here if I can. Here we go. And this is a graph. Now, this graph here is a graph of the shares of Walmart. Now, this goes back 4.5 years. In the last 4.5 years, shares of Walmart have gone absolutely nowhere. Nowhere. In fact, you see the range is between $48 and $54 a share. If you were to show this graph to a physician, you know what they would say? I'm really sorry to hear about your father. This is nothing. Absolutely going nowhere. And you say, how can that happen? Walmart has taken over the free world. Why is that happening? Well, the reason it's happening is that you've got 2 moving parts. For instance, Walmart stock, The end of last year, $54. The earnings were $2.32. The PE was 23.3. 2 years ago, stock was roughly at the same price, but the earnings were $1.77, but the PE was 29.4. 4 years ago, the earnings were only $1.20, stock at the same price, but the PE was 44.2. The stock has remained flat as the EPS growth has mirrored the decline in the PE ratio. And the reason is the stock got too high. The PE ratio should be about equal to the growth rate in the company's earnings annually. There is no way a $300 billion company can grow at 44% a year. It can't. Just be logical about it. That stock was way overvalued. I was telling everybody about it. Because a $300 billion company can't grow at 44% a year. If it did, in 2 or 3 years, it would take over the free world. China, Venezuela, Chile. That's what, I mean, it wouldn't work. It's ridiculous. Who's doing the math here? Here's a couple other ways to look at the stock market. We like to look at something called PEG. And I think this is a terrific method. I'm looking at Coca-Cola here. I'm not making fun of Coca-Cola. I love Coca-Cola. I've had 5 Diet Cokes already this morning, which is why I'm like this. But it's shopping at midnight, gotta go. And but here we have a situation, something called PEG, which is price-earnings ratio divided by growth rate. So if you look at the PE for Coca-Cola is 20.9. The annual growth rate in earnings every year is expected to be about 8.9% a year. That's Wall Street's estimate. 20.9 divided by 8.9 equals 2.34. 2.34 is not cheap. Historically, the PEG on the market has been 1. Stocks have sold at a PEG of about 1. In other words, the PE ratios have been about equal to the growth rate. Now, I don't want to make fun of Coca-Cola because it is the largest holding of Warren Buffett. And I love Warren Buffett, but I like Jimmy Buffett. I really like them all. So let's see. And then here's another example of a way to look at the market. Enterprise value divided by EBITDA. Enterprise value is how much is this whole company worth, kit and caboodle. It's the equity market cap. In other words, the number of shares outstanding times the stock price, plus all the debt, minus the cash and marketable securities. Because what you're trying to do is measure how much would it cost you to buy this whole company. Because you'd have to buy all the stock, all the debt, and be able to use the company's cash to help finance the acquisition. Divided by EBITDA, which is basically cash flow. Coca-Cola sells its company's worth 14.3 times cash flow, but other companies, smaller companies, I used Oil States International, little company we follow, 9.5 times cash flow. What I'm trying to get at here is that there's a big discrepancy in pricing in the market, and it's going to be very much a stock picker's market going forward. Stocks are not equally valued. I want to talk about the bear market, because the bear market, believe it or not, is the best thing that ever happened to you. Because people got themselves so blown up in the bear market of 2000 and 2003 that finally they're interested in the products we're talking about, sensible products, products you can rely on, asset allocation, planning, tax advice. Back in those years, they didn't care anything about that. They said, no, my brother-in-law has an idea on a .com stock, and he's got a computer, so I'm sure he's good. And that's what happened. And so the bear market turned out to be the best thing that ever happened to you, even though you'd never sign up for it again. Take a look at these 37 months. The NASDAQ composite fell 73%. The NASDAQ composite was almost all tech stock. These were companies with no earnings, no cash flow, no assets. Who knew? And I'm going to tell you something that I usually don't share with anybody, but Mr. Lonnie told me it was okay because we're like family. Is the 73% is a lot because 100 is the highest. That's a bit just between you and me. The S&P 500 fell 35%, but you know what? The rest of the market did not fall. The Value Line Index, which is what I like to use for academic work, it looks at 1,700 stocks. Let's say ExxonMobil is the largest company in America and Pep Boys is the 1,700th largest company, something like that. What it looks at is these 1,700 companies unweighted, and a 1% move in the shares of Pep Boys would have the same impact on the index as a 1% move in ExxonMobil. And what it does is it gives you much better breadth of the market. And when you look at it, it was dead flat during that whole bear market. So what happened was the market did not go up and crash. In 98 and 99, about 80 tech stocks went up way too much. And in the following 3 years, those same 80 stocks gave it all up. The rest of the market was not doing that at all. I wanted to talk about a bear market, but I didn't want to use a really scary bear, so I used Yogi Bear. And hey, boo-boo, what are these parentheses in my account? And but Yogi, and I'd really like to work on these here. Those look much more interesting. Is basically the first stage is denial. The economy shows signs of slowing. Investors say, don't worry, the bull market will last forever. Then reality sets in. Stocks continue to decline. investors realize how weak the economy really is, and finally surrender. Fear of deeper losses in a recession becomes so worrisome that investors give up on stocks and set the stage for rebound. I happen to know a lot about where these cycles are just by public speaking, because when the market's really bad, people don't want to hear about the economy and the stock market. It's the bull market started in '82. When I started in this business in 1979 in Boston, I remember being in cocktail parties, and people would come up and they'd say, "What do you do?" And I'd say, "I'm a portfolio manager." And they'd say, "That must be fascinating. I'm going to freshen my drink. I'll be right back." And you'd never see them again. You know, and then the 90s, that wasn't right. You told people you were in investments, and people are all over you like a bad suit. You know, it was like, hey, your investments. You like Microsoft at 130. You like Johnny's boy in the fourth race. You're like a bookie. You know, that wasn't right. So I think we're back to some normal level now. Here's an important point. It's not a stock market. It's a market of stocks. And I think this will help out a lot. Okay, all right. Because I think investing is a lot like baseball. And I know you still have the Blue Jays, so I think this is going to work out. Okay. See, it's a lot like batting. See, you're investing up there. If you see, you don't have to swing at everything. That's what a portfolio manager is supposed to be doing, is finding stocks that have a positive risk-return trade-off, investments where the return is greater than the overall risk. So you're up there, and you see Coca-Cola come by at a peg of 2.34, and you take that one. You don't want it. You get yourself settled in. And they always do that, too. I don't know what that's about. But it's, that's another, not sure what that's about. And then you see, I don't know. Then you see maybe Walmart come in at 15 times EBITDA. Just let that go. And then, oops, where are my steroids? And then finally, you just wait for a stock that has a positive risk-return trade-off. That's what the portfolio manager is supposed to be looking for. And then you step in, you turn your wrists, and you drive the ball. And that's what we're supposed to be doing, not buying the whole market. That's what a manager is supposed to do. And let's see. I always hate it when I have just the one white glove on. You always think you may be a member of the Jackson family. You know what Michael Jackson likes best about 28-year-olds? There's 20 of them. It's a math joke. I'll give you later today. That'll hit you. My 7-year-old told me a great joke the other day that you can share with your 7-year-olds. He said, "What did the zeros say to the 8? Nice belt." Isn't that great? That is a cute joke. Now, a lot of people have trouble deciding what is the market, what is the stock market. Some people think the market is the Dow Jones Industrial Average. I don't think that's a particularly good average. It only looks at 30 stocks. It was invented in 1896, which is okay, because in 1896 there were only about 31 stocks trading, so it worked out pretty well. But so that's not a particularly good index. This is the NASDAQ Composite, and if you look at the NASDAQ Composite in here and you say, well, where are we in this whole thing? Well, you see the NASDAQ Composite is around the 2100 level. It was as high as 5,000 5 years ago. So if you look at that and you say we're 2100, we're as high as 5,000, we could more than double just to get back to where we were before. And you say, well, that's pretty attractive. Or you go ahead and you take the next one. You say, what about the S&P 500? Maybe that's the market. Well, you look at that, and we're at about 1,200. It was as high as 1,500 5 years ago. So we could go up 30% just to get back to where we were before. But I think that's really not the best way to look at it. The best way is that value line index. It's going to give you a much better picture of the market. And you'll see something very interesting. We're not trying to get to old highs from 5 years ago. We broke through all the old highs 2 summers ago. And the market is in uncharted territory. It's actually been a terrific market if you had just stayed away from those large, overloved tech stocks. And I think that really, that's the real surprise in all of this. Where do I worry about? I'm not worried about the financial markets. I think they're going to be fine going forward. What am I worried about? I'm worried about the speculative real estate bubble, particularly in residential real estate. I know this because no matter where I go, that's where everybody's putting their money. You can't put them in stocks and bonds because they think houses will go up 20, 25% a year forever. And I have a little index I use, my cab driver index, which is whenever I get in a cab and I tell them where I'm going and what I'm going to do, they always tell me, almost for the last 2 years, every cab driver has told me, oh, I'm pooling my money and with a bunch of other guys and we're buying speculative real estate. And I know if they're doing that, that can't be the right thing to do. It really can't. These are the same cab drivers that told me to buy the internet stocks in '99. So it really is. I was a guy from Baltimore. I was in Baltimore about 3 weeks ago. The funniest thing, he tells me about he's putting his money in real estate and all. Then he shows me, takes off the passenger seat and gives me a graph showing me why they'll go up 20% a year forever. And I thought, God, this is amazing. And I'm trying, he was from Russia. What was his name? Oh, yeah, Pick Up and Drop Off, which I thought was a great name for a cab driver. But let's see. Here's what I worry about, the housing market. This is a great index. This was done by a professor at UCLA, and it's a housing market PE ratio. That's the way I like to think of it. It's median home value divided by the average annual rent for a two-bedroom unit. It's the buy versus rent decision. For instance, if the average monthly rent in a two-bedroom unit is $1,250, that would come to $15,000 a year, and the average house in the area costs $250,000. You'd have $250,000 divided by $15,000 equals 16.7. So the PE would be 16.7. Now look at what's happened in the market, particularly in some of the northeastern markets and the western markets in the U.S. In Boston, the PE of the market is now 30.2. It was just under 20 in 1988. This means the buy versus rent decision has completely gone on its head. If you look at San Diego, it's almost 30. It was 23.4 in 89. San Francisco, 27. That beat its peak of 89. And just to show you it's not across the board, New York, 22.5. It's been as high as 28.6 and as low as 17.6. But you look at that, and there are some markets that are tremendously, tremendously overvalued. There's conventions all over the United States and Canada, telling you how to buy real estate with nothing down and all that. That always means the peak. When everybody's talking to you about it, it always means the peak. Here's another example. Average median home value divided by average annual income. In 1994, it was 2.4. Now it's 2.8. Which means the average home now is 2.8 times the average annual income for the person in it. Those numbers shouldn't change. What could cause the decline? Higher interest rates. The market says interest rates are going to go much higher. If they do, you are going to see a collapse in real estate. You have to see it because people have maxed out. 2/3 of all the mortgages last year were interest-only or adjustable rate mortgages. Think about what's going to happen over to that scenario. If they're buying as much house as they can possibly buy and the interest rate goes up, the only way, if that mortgage payment can't move, the value of the house has to drop. Local economic shocks. We saw defense cuts in Southern California in 1990, the oil bust in Houston and Louisiana in the mid-'80s. It got so bad in Louisiana. I'm not saying this is going to happen, but I'll just show you what happens when you have a decline like this. In 1986, the price of oil dropped to $9 a barrel. Everybody was laid off. And all of a sudden, they were having to pay. They needed to get people out of Louisiana so much, they were paying college kids $100 to drive U-Hauls in to get the people out. And it was just unbelievable. In fact, Lafayette, Louisiana, where my wife is from, is the oil-producing part of the state. And because you saw this in Calgary and Edmonton too, is it was so bad there in the middle of the 80s that the Chamber of Commerce decided, the city of Lafayette decided, we have to do something for morale. So they started putting up these billboards with little fleur-de-lis on them that said, "We believe in Lafayette." And my wife said within 2 days, the DJs started referring to the signs as, "We believe in Lafayette." So it's a very different thing. Now, the other thing about housing is there's a tremendous lack of liquidity. Stocks and bonds you can get out of like that. You don't know what price you're going to get, but you can get in and out immediately. Housing is very difficult to get out of. In an up market, it's very liquid. In a down market, there's no liquidity. And the enormous leverage. If you buy stocks on margin, you have to put up to 50% down. And if I was buying stocks on margin, you'd say, "Look at Peter. He's as crazy as a loon. He's a riverboat gambler." That's what you'd say. But what do you put down for a house? 5%? Less than 5%? And nobody has any equity in their homes anymore. They're all at Ditech. And it really is. Everybody's used their houses as giant ATM machines. And I don't know how long that's going to... Believe me, home equity loans are the weapons of mass destruction. That's what we were looking for. Let me just jump ahead to something for a sec here. Okay. This shows you over the long run how historic rates of return have been. This is all done by Professor Ibbotson. You have those graphs, don't you, that show how the market... I have this great nightmare. I don't know if you have this too, where I wake up in the middle of the night, I get down, I get my paper, and the front of the paper says, "Ibbotson indicted for fraud." And it's like, I made the whole thing up. And so it's, But no, they're the greatest people in the business, and this is what's helped us keep long-term perspective. You can see over long terms, large cap stocks, 10.5%, small cap, 12.7%, bonds, basically in the 5.5% range. And it gives you an idea of where your rates of return have been historically. Now, right now, I know what you're thinking, which is, where did they find this guy? And for heaven's sake, why did they let him work with children? And so I thought I'd show you what I do at Tulane. I started this in 1993, the Birkenroad Reports program. And hopefully they got here. Everybody's got one? Yeah, in the U.S., everybody complains about the Postal Service. So I don't like that. I think that's really mean. Like, you'll always hear people say, oh, I can't believe it costs 37 cents to mail a letter. I want to look at them and say, hey, if you take from the day they pick it up to the day they deliver it, what is that? That's nothing. It's like a penny a day. It's nothing. It's, so it's, the other great thing I love about traveling is wherever I go, I get to drive around a little bit. And I don't know if this is true in Canada or not, but when you're in Canada, when you get on those side roads, do you see those little crosses on the side of the road? And it's wherever you go, you see that. And when you see that, particularly on the smaller roads, it makes you think. I don't care where you are, what walk of life you're in. When you see those little white crosses on the side of the road, it makes you think. It makes me think that maybe Jews are better drivers. That's what it makes me think. Because you never see a Star of David, little Buddha, anything like that. So just a thought I've been working on. There's the other great thing about being with you is you people do mathematical things for a living. So I don't have to worry about that. Sometimes I'll give a talk and they'll say, oh, it's too math oriented, particularly in America. Americans are terrible with math. You know what they say? They say we're only using 20% of our brains. That's what it says. Every time I see that, I think, God, what am I doing with the other 70%? So it's, but it's, in fact, my favorite example was, of bad math was a couple of years ago. There was a football player for the Minnesota Vikings, and he was arrested for driving his Mercedes filled with marijuana and pushing a traffic cop down the street on the bumper, which I think we've all done. I don't think that's, but it's, and so he goes to jail, and then he comes out the next day, and he has a press conference in front of the jail, and I'm watching ESPN with my son, who's 10 years old, and he comes out, and the football player comes out, and he looks in the mic, and he says, I've been bad, but I'm going to turn my life around 360 degrees. See, the expression is 180, so my 10-year-old son says, Dad, that's not good. That means he's going to be bad again. I said, that's the worst part, really. Oh, God. But this is the program I started, and we have a great time. A couple things we're really proud of. We've sent 450 students from this program onto jobs in the investment business, which has been really terrific. It's been a great springboard. The other thing we're really proud of is on page 2, about 3 years ago, one of the local banks, like we were doing so much following these stocks that nobody's ever heard of, these stocks under rocks, that they created a mutual fund of these using our research, and the ticker symbol's HIBUCS. And you can see in the first 3 years, it was up 66%, and the market was only up 11%. It beat 98% of the nation's mutual funds, and it got a 5-star rating at Morningstar, which I think is just hilarious because I do have the lowest payroll on Wall Street at 0. And I just put them in the car, some Cokes and some, muffins, boom, we're gone. It works out perfect. And then there's a company called Nelson's that calls the director of research at every firm in North America. And they call and they always ask the same question every September. They don't know we're part of a university. And they call and they say, has there been any turnover at your firm? And every year I say, yes, all 200 are gone again. So it's I know she's right. This is the worst manager I've ever seen. So let me just show you a couple of I'll show you something. Here's some inside. See this card? You know what that's held on by? You know what that's called in the business? Booger glue. Isn't that great? They just heard that from the printer. That's terrific. When I learn something, I want to share it with you because we're like family. Let's take a look at page 5. I'll show you a couple of these stocks that we follow because I'll show you that they're companies you really know. Allied Holdings is a company that moves 90% of the cars in Canada. They move them basically to the dealerships. You see those big trucks on the interstate, those green trucks, and they say they hold like 11 Ford Tauruses and unfortunately like 2 Hummers, which is one of the problems. And the company was going out of business a couple of years ago, and they got a turnaround specialist in there, and he made one big change. He went to the existing management. And keep in mind, they have 2/3 of North America, 90% of Canada market. And he went to existing management, and he said, you know what? He says, we're going out of business here. We're going to have to do something to raise money. We're going to go to the big 3, Ford, Chrysler, and GM, and we're going to tell them we're going to raise the amount we charge to move each car. And all the existing management said, oh, God, don't do that. Don't do that. If you do that, they'll bring the business to someone else. And he said, who? He was like, oh, yeah, you're the man. You're the man. Woo, woo, woo. So that was a great moment in business history. Let me give you a couple others that I think are kind of funny. Craftmade International on page 13. There's a company that makes ceiling fans for kind of hot weather areas. You'll see those ceiling fans around. And It was our first company to follow in Texas. And Texas is next to Louisiana. Louisiana is a very humble culture. It has a large French-speaking population. And Texas is really very bravado, kind of prideful people, and I think too prideful. So one of the old story goes, it's odd that we're next to each other because we're so different culturally. And the old story goes, the Louisiana farmer meets the Texas farmer, and he says to the Texas farmer, how big is your property over there in Texas? And the farmer says, well, let me put it to you this way. I get on my tractor first thing in the morning, and I have to ride all day long till I get to the end of my property line. And the Louisiana farmer says, whoo, I had a tractor like that once. These are some of our little setbacks. Let me give you another one on page 20. You can all relate to this stock. Golden Enterprise, they make snack foods. They make potato chips and things like that. And we were visiting with them. And, we always take these little airlines, and we take Southwest Airlines mainly when we're going. And it's open seating in Southwest Airlines. So I go in with my students, but we got separated. They were sitting about 5 rows back of me. So I'm sitting next to a real good old boy with overalls from the state of Mississippi next to me. And he's telling me how he's never flown before. And I do what I always do in that situation. I pretend I don't speak English. Non parli inglese. And so he's gabbing with me the whole flight. And all of a sudden we land in Birmingham, Alabama. And there's bad crosswinds, so when we land, we bounce back up again. And, of course, the plane gets dead quiet. It's not dangerous, but it scares everybody. So the plane gets dead quiet, and he turns to me in the loudest voice and says, whoa, sounds like we hit a dog. It was unbelievable. It was, oh, jeez, says, God. And these small companies, it's so much fun to follow because they tell the truth. Like 3 years ago, they told us they were going to build a plant in Tennessee making healthy, low-fat baked potato chips. We went to see them this spring. I said, how's the plant going in Tennessee? And they said, not good. We closed it. I said, what happened? And he said, well, we found out something very important. I'm going to share it with you. We found out people on diets don't eat potato chips. That's the kind of information you're getting right here. On page 31, you see a company called Mid-South Bank Corp. The regional bank stocks have been tremendous investments. And this is a funny company because you see the ticker symbol on it is MSL. And about 5 years ago, they got a call from the New York Stock Exchange asking if they'd be willing to swap ticker symbols. And they didn't do it. And it turned out who wanted the symbol was there a new company going public. It was called Martha Stewart Living. And that turned out differently. And I do believe, by the way, these corporate scandals have been miserable for all of us. As financial professionals, as investors, for students, it's been just devastating. And because they wonder if the game's on the up and up. And so I think it's been very, very difficult, but I believe in the long run, we will get a new credibility back to financial statements, and I think that's going to be good, really good for all of us. In the meantime, I think we're going to have a lot of CEOs going to jail, sitting in their cell, reading that new management book, Who Moved My Soap? And so it's kind of a prison joke, really. Who doesn't like a prison joke? And finally, Finally, on page 41, I'll finish up on this. And first of all, thank you so much for having me because you've been so terrific. And early in the morning, sometimes they're not terrific. So this has been so great. And I got to tell you, I'm a very, very lucky guy. I have a wonderful wife, 2 beautiful boys. I love to teach for a living, so I'm very blessed. And I don't have a mean bone in my body, but the one mean thing I do, which I love so much. I just can't stand it thinking about it. Is I like to take the prissiest students and put them on the grossest field trips. It just makes me happy thinking about it. Like Sanderson Farms is a chicken processing company. If you've never been to a chicken processing company, do take the family. That's a nice outing. So I'll see a girl maybe that grew up in Manhattan, very privileged, went to private boarding schools. Like, Julie, you'll be following Sanderson Farms, the chicken processor. And she'll say, how was I selected? Your accounting background. Get in the car, Julie. And it's great. It's terrific. She wakes up in her dorm bed for about 6 weeks in the middle of the night going, ah! But if you've never been to a chicken processing plant, this is the way it works. They take us, probably we're having for lunch, but they take a truck full of live chickens and they back it up to the back door, and the first room is rather dark so as not to alert the chickens to their fate. And then they got 50 or 60 men and women in shower caps, and they take the chickens by the feet and they put them up in these stirrups so the chickens are upside down. They're like, arr, arr, arr. And then they go for about 10 feet, and then they get their heads dunked in this metal tray with water in it. So then they come out for another 10 feet, and then whoo! They get their heads cut. I know a lot of people say, "Oh, I thought they got away." No, very few get away. So I really worry about this generation. A couple of years ago, I got a girl from Kentucky, 2 guys from New York, and we just seen this part of the process. And one of the guys is from Queens, and he asked the CFO during the tour, and the CFO's name is Mike Cockrell, and Cockrell is Latin for rooster. I mean, who could make this up, right? And so he says, Mr. Cockrell, I noticed the chickens, like just before they get their heads cut off, they seem like really calm. Do you think like at the last minute they like find God or something? Thinking, oh my God, I'm looking for a hole to fall in, you know. And in Mississippi, they're so polite, they're so nice. He says, well, perhaps that's certainly one explanation. I guess the other reason might be that metal tray with the water has an electrical current running through it. So, yeah, thank you so much for having me. Appreciate it. Thanks.